Welcome and happy Friday, Pat.
What's up, Rick? How you doing, buddy?
Oh, doing good, doing good. This is Pat and I get together every Friday and do our best not to exceed expectations. So we try not to disappoint today. And so we're going to go over a bunch of them. But I want to announce our sponsor that we have for the show, which is Red Hog Media. And if you're a real estate agent, I highly recommend Red Hog Media. I use them for all my listings, but they also do businesses. They do not only photography, they do video, they do 360 tours, they do drones. They have great packages. And when they send you your photos, they send it an entire package of media kit with a media kit. And like I say, they do small businesses as well. So this just isn't for real estate agents. So that's Red Hog Media. And if you get on their website, they have a discount code. And if you put in Rick Helps, you will get a whopping 10% off.
There you go.
Pretty cool, huh? And I bought the number one selling hat today from the Rick Helps real estate store. It's number one because I bought one. So that's something to consider down the road. So
well, I got to give you kudos for coming alive today and not being dead from the fact that tell everybody that you've been doing your 4-day fast.
Yeah, well, I went on a water fast and I was going to see how long I could do it. And I did it 86 hours, just that's water crazy. And minerals. And Daniel, I don't know Daniel, I don't have any data for the Flagstaff market. I wish I could. I highly recommend Redfin, though. They will. So I wanted to, and there's a bunch of reasons I wanted to do it, but it really cleanses you, and I'm trying to drop some pounds. And I made it all the way to today. Today I said, I'm done. I've already lost 10 pounds. I feel a heck of a lot better. And so I'm ready to keep going on this journey. But that was a long few days. Day 2 was hell. And after that, it got really surprisingly easy. So cool. I was updating you on a daily basis, just to let you know I was still alive. So,
well, Daniel, can I ask you how you should go to Redfin and get the Flagstaff information? That's how you would do it.
Yeah, I would go to redfin.com and just put in Flagstaff, and it's got the stats on listings versus this year and last year. Okay. I can't remember who it was that said in the predictions of the markets that were overpriced, there was a data center that said that Flagstaff was overpriced by 65%. That does not mean that their prices are going to come down 65%, but they expect a significant decline. So we'll see. But I want to start out with this. And I touched on this on our show last night, the average list price. And I said it was down below 2021 levels. And I couldn't figure out when I looked at their other chart, now it wasn't. And then I found out the problem. I was including, in this one, it includes under contract backups. When I removed that to just active listings were down below 2021. So that's where we're at today. We've come from a high of $401 a square foot down to $324. And these are just the listings. 5 in Van Lake Havasu, same thing. I only have the Phoenix metro area and the Southeast Valley down to Maricopa is where, and the West Valley, as far as the data that I'm showing you here. Anything outside that, I just don't have access to. I apologize. I'm looking at last year's predictions, Pat, and seeing where we're at now. And I think I've shown this before. Realtor.com said we would be up 2.9% on price appreciation. That might be relatively close. Existing home sales up 6.6. That's way down. And existing inventory up 0.3. It's up far higher than that. The big miss, average 3.3% through the year, 3.6 by the end of the year. Are they close there, Pat?
Nope. Couple points higher.
1 or 2. Single family housing starts up 5, homeownership rate 6%. Daniel says Caitlin this morning showed listing prices are down 12%. Median sales prices are already 6. She is correct. Yep. Would you help me write up a sales contract for 1%? Sell my house. Just need help with the contract part. Shoot me an email, rick@rickhelps.com, and we can talk. Appreciate that. HPI Case-Shiller trends. This is kind of an eye chart, and it's national here. It's showing that basically they're saying the HPI is an index and the Case-Shiller index forecast, which has been kind of accurate. This is year-to-date growth. So they're showing going out a year that we're going to be down about 3 or 4%. They are not showing negative, though. Zillow home values, they were saying that, let's see, they revised their forecast. Outlook for home prices has been revised down significantly. They forecast 2.4% home value growth through the end of July 2023. So they're projecting us to go flat and then only be at about 2.3. And I've seen that for the most part everywhere. Redfin 2022 housing market predictions. Prediction 1, mortgage rates will rise to a blistering 3.6%, bringing pricing growth down to earth. Lord, if we were at 6% right now, I got a comment. I got rid of the A in the background. Because people didn't know it was Arizona. And now, as a public service, this is where Arizona is. So we're so helpful on this channel. I mean,
try to be.
So summer's supposed to be the busy season. Not really, but it's going to slow down between now and Christmas, no doubt. So anyway, they're saying declining mortgage interest rates as they rise, existing home sales and price growth. New listings will hit a 10-year high. That's happened.
Yep.
But I want to put a caveat on that. Not new listings. New listings are down, and I'll show you. These are new listings here, the blue line. And the yellow line is number of homes that have gone under contract. New listings are down. Active listings are up because we're not selling as many homes. Rent prices will increase. That is true. Rents and home buyer mortgage payments both rising sharply. New listings down 17.5% year over year. And that's what I just showed you. Again, this is Redfin. So that's kind of what's going on in the market as far as predictions. And we are continuing to see the same slow march of listings coming up. We are sitting at about, let me look real quick here. I think we're 19,100 listings today, Pat, 100 less than last week. And strong labor market per pal. How is this currently affecting the market? The real estate market is rate driven right now, and that's certainly what we've seen. And Pat, tell us what's going on there.
Yeah, we're seeing. Today was kind of we've been in this staircase. This is the price once again. I should probably switch this again because I hate to confuse people, but let me just switch this up to the rates. The 10-year Treasury. Come on here, we can get it. Probably, maybe not going to get it. Okay. I don't know why my computer's not. Anyway, this is the staircase climb downward in price and then rates up. So we're stuck in this channel. Oh, now my computer. Why is my computer?
We actually went down a little bit today, didn't we?
Yeah. Give me 1 second here. My computer is acting up here.
It does. It just knows when it's Friday. You're probably humming along.
God.
Monday through Thursday, and then
there we go. Okay, here we go. Let's switch in. There we go. There's the rates. The staircase climb up since beginning of August. Okay, here. Come on. Why am I getting delayed here? So now we're kind of obviously plateauing here at about 331 on the 10-year Treasury. Yeah, the market was kind of flat. We saw there's been some gyrations day to day. I mean, it'll open up plus 13, 14, 15 basis points, and it gets negative. We saw, obviously, this turnaround here. This is down 22 basis points during the day. So we've been seeing some daily gyrations in terms of. Give me 1 second here. I'm sorry. This is
while you're looking at that. While you adjust that, I'm going to pop up the chart here because Brendan had sent us a comment here. He said, "I'm seeing there are an awful lot of amount of $1 million homes in the Phoenix metro area, and there are 320 right now compared to last year. Last year's the blue line, 135. So Brendan, you are correct. Back to you, Pat.
All right, sorry about that. So this has been the staircase climb upward, obviously, in rates, and we got, like we saw the anticipation last time when the Feds came, met. They're meeting obviously the 21st and 22nd, and then next week, Tuesday and Wednesday, we've got the CPI and the PPI numbers out on Wednesday. So, I mean, this could be, if those numbers come in, that might be bond positive. Obviously, I'm thinking that we'll see rates fall back a bit. I mean, and another thing is going back to here. This is what I think you have to look at too, is the inflation numbers. Barry Habib that I follow on the MBS Highway. This is the inflation numbers from last August, 0.3%, and we saw a rise to 0.9. Now this is the most recent inflation numbers. May, June was 1%, 1.3 on a monthly basis, and then in July it fell. And they're saying it's going to be negative 0.1 in August. So the thing of it is, with the CPI numbers coming out, the PPI numbers coming out, they're thinking that the Fed's stepping on the rates, 0.75 of a point the last couple meetings, that they said they will keep that foot on the pedal, because I guess, Powell is now, like I said the other day, is that doesn't want to look bad, and he's going to keep his foot on the pedal through the next, I think, couple meetings. But if you compare the inflation numbers from August to August, you're going to see a dip. I mean, I think you'll see inflation is looking like it's kind of hit a peak short term. So,
yeah, and they're going to watch it for a long time because they want to stay at lower than 4%. I saw an interview with him, and he said, comparing and going back and talking about Paul Volcker back in the late 70s and early 80s, how he had to go up to 20%. Mm-hmm. He said, looking at history, the only reason he had to go up 20% was because he didn't get aggressive enough early enough. And he said, and we're not going to make that mistake. So he said, so we're going aggressive now early, so we don't find ourselves in that situation.
Yep. Because he said, I'm sure people have heard failure is not an option. And so they're going to focus on inflation. So it's,
I don't see him pivoting. Do you? I mean, he's going to go 0.75, and he doesn't give one rat's patoot about the election. No, he's got to clamp down on inflation.
He's got to. They've been wrong so many times this last 2 years as far as being behind the eight ball, that they have to stay on this. Nobody knows, got a crystal ball, but I think, he's going to keep it going here, September. And then there's another Fed meeting November 2nd. So September 21st, you got a gap in October. So it's like you said, I think, June, we're obviously, even March, obviously look at the inflation numbers. But I think it's good. They're doing the right thing. I mean, he said too, remember he had said that, and I think, correct me if I'm wrong, if you heard this, but, he's using this interest rate to use that to tap down home prices.
Yeah. And it's working. Take a look at our contract ratio.
Yeah.
Over here, we're down to 44.9, and we peaked up here in April 21 at 307.6 as a ratio. So it's definitely doing the trick. But the market that I think is going to be interesting to watch come January, Pat, and that's the over 55 areas. Because I'm looking at, for the past 2 years, we'll just take Sun Lakes, for example. They've had 25, 35 listings. And today they have about 95, and they will peak in February. Normally they run about 125 to 150. I think they're going to be way above that because people have just not listed their homes because a lot of them weren't here during the pandemic. They were from Canada or they're anywhere else where they couldn't travel. So they came out and enjoyed them this winter. And so if they're going to sell, I think they'll probably sell next year. But I think there's going to be some real opportunities in the over 55 markets. And those markets are not interest rate sensitive. Would you agree?
No, they're not. They're really not. Number one, I mean, a lot of them pay cash or put big down payment down. And I think a lot of those guys, I hate to say that I'm in that over 55 community, which kind of blows my mind. I know I don't look like it, but
Oh, you're just a spring chicken. So.
but I think I think a lot of those people too, quite frankly, they understand, they've been in that market of 18, 15, 16, 17% interest rates. So whether it's 3% or 4% or 5% or 6%, I mean, a lot, people I've talked to in the last couple of years, obviously, it doesn't bug them as much that, they're not getting a 3% interest rate. They're like, yep, okay, we know it's 5.5% or 6%. I mean, that's kind of my take on it. But like a lot,
they're not coming in with 5% down on those. They're coming in with significant down payments if they even have to finance at all. And Thomas says, do you think that the luxury apartments being built will affect the housing market at all of the next year or two? That's pretty isolated right to Phoenix, the luxury market. Out in the East Valley, they're almost luxury, but not quite. Tempe, to me, is out of control. Those places are expensive. I don't know how. Well, I know how college kids can afford it. They're borrowing money. And but that's where I think something's going to change. Is they're already complaining that they can't afford the housing in Tempe. I think that's going to turn. That's going to plummet because, I mean, you drive down Apache Boulevard there. It's crazy. But downtown Phoenix, there has been some real demand for luxury apartment living, especially if you work downtown. Now you've got that nice big Fry's grocery store right across from the ball field there. So it's kind of an attractive place to live if you like city living. And there's some amazing places for you to rent down there. But boy, you better bring some serious coin with you.
Yeah, it's crazy. It's absolutely crazy. But it's interesting. I mean, once again, I mean, I've said this several times the last couple of months, but I think obviously everybody's trying. We're just, you and I are just trying to give information out there that people can make a good decision. What's been currently happening, but everybody's trying to wait for that bottom. And like I said, once again, I think you just have to piece your decision making into this segment, into the certain areas, 6 to 12 month and 18-month segments. We're into this. We came out of this last period back. It started March, April, May. Things started cooling off, and we're probably going to be in this cool off period for next. What do you think next?
I think so. The Cromford came out today and said that sellers can celebrate the number of cities with improved CMI the past month have doubled. Chandler has joined Paradise Valley through its rise the past 31 days. Basically, they're saying that Chandler's now gone up. They're 92.6. Remember, they used to be about 450. So I don't think there's that much to celebrate. The average CMI was -9. It's another improvement on the week before the reading was -15. But I'm just going to throw out a carrot on that and say most of this data that you're looking at now is before we popped up to over 6% again. So I think you're going to see that change again. That's just going to bounce like a ping pong ball on the show you never saw, Sing Along with Mitch.
Well, I think, we had talked about a couple weeks, last couple of weeks we started, and I read something about, this theory that, it's going to be tough to get stabilization if you see rates going from high 4s to low 6s within about 3 or 4 weeks. It's tough to get any type of stabilization in the market because people, they see it 4.5 or high 4s. They make a decision that they want to do something. All of a sudden they skirt up to say high 5s within 3 or 4 weeks. All bets are off.
Yeah. And I think but I think last month really showed how interest rate sensitive this market is, because we had like 2 really good weeks in August and then it fell off the face of the earth. And I know I get comments that say, I don't care what kind of chart you show. Here's what I think. Well, I like data. I like looking at charts versus having a gut and asking the guy at Home Depot what to think. But it shows you clearly here that our listings are plateauing. So we're not getting a lot of people saying, here I come. And I heard a news story today, and you've seen these stats because you've quoted them, that less than 1% of people in Arizona have negative equity today.
Yeah. So
And speaking of Arizona, have you seen the migration data? 40,000 people came from California to Phoenix Metro, 7,000 to Tucson. 10,000 of you are from my old neck of the woods in says Washington, 17,000. Texas is 10,000. Okay. California is 64. That's total. So I'm reading this wrong. So Illinois, 9,000. Colorado, 8. Florida, 69. So this is where everybody's coming from. But the interesting thing is, in this article, they put up a chart on net migration here somewhere. I had it. So don't feel bad, Pat. You're not the only one scrambling for charts. Here it is. So net migration. And you know why that is? Because a lot of us are dying.
well,
So people are
really
moving
positive.
in. People are dying. So we have a net migration. Just all these people coming in and just we're flatlining. So it's who knows? There's a lot of stats out there. Brendan once again says, I feel Toll Brothers Lennar are getting hit hard right now. New construction permits. You know, they can have the permits, Brendan. It's whether or not they act on those permits right now. So they have the permits, they've stalled, and they are discounting their prices like crazy. And who's buying these homes? Single families are buying them. I'm seeing, I have 3 under contract right now. All 3 are first-time home buyers. One's a doctor, one works at Intel, and one's a single gal that's buying a townhome in Tempe. So they got really good prices on them, Pat.
Yeah. I think they're doing the right thing. I mean, I think this period we've talked about, I think once again is going to be a positive for people that are really serious. You know, you're going to have those people that are always going to try to find the bottom. They're not going to be able to find the bottom, but I think this pause is been good. Obviously, do you think we're going to, see prices soften up a little bit more? Well, probably, but this is a hell of a lot better time frame to be buying than when you had 30 or 40 offers out on one home.
Well, there's definitely opportunity out there if you want to look for a home and you want to see what price you can get it at. The buyers are not offering listing price at all. They're coming in lower every time, not just.
What about that open door thing that we talked about? I think they should probably start calling it closed door.
It's I wish the public had access to look at this, because we talk about it, and I can probably share some of the numbers here, but when you go in, but I would end up showing an address, so I really don't want to do that. But the price that they paid versus the price they're trying to sell, I know they get a lot of venture capital, but why and how? I mean, you see examples, they paid $560.
Yep.
And they're selling it for $4.25.
I know.
So, I mean, if you're investing in this company, you go, that's a solid plan. Here, have some more. I mean, Zillow tried it and they failed, but their revenue is from advertising to real estate agents. So 70% of their revenue was from another bucket. But Open Door, theirs is all based on appreciation. And I've been wondering for a couple of years, what's going to happen when the market goes flat? And now prices are declining, and they've got 1,900 homes on the market right now in Phoenix. And they're a large part of that list price number coming down. Not a large part, about 10%.
You took a look at some of those examples I sent to you.
Yeah.
I mean, I was amazed. I mean, I don't have it in front of me, but I picked up like 6 or 7 or 8 examples, and it's like, holy mackerel. I mean, they're buying stuff for $550, trying to list it for $580, but then, 30 days later, they're throwing it out there for $490.
Yeah. And I wonder, Tyler's saying that, they bought into an area at an inflated price so they could sell the other 20 homes at that inflated price. I don't know. Some of the stuff I look on, by the way, Tyler, I didn't think you'd be on today. Tyler lives in Ensenada, Mexico, and you guys got your butt kicked last night with a tropical storm and hurricane. So your electricity must be back on. So I'm not sure, what their overall impact is, when they're buying, 500 homes. And when we look at the mix of homes, they're all over the board. And I've been surprised at the crap they bought, the older condos and the townhomes that they bought. Even after they fixed them up, they were still no bueno.
Yeah, exactly. Yeah, it's just an interesting concept. I just cannot. It's almost like they bought us. The stock went from 10 to 20, and they're giving you
Hey, Sean.
$25 a share for the stock, and they're turning around, flipping it back down for 18. It's
Yeah.
just that's
Yeah.
that's
I
what
don't
it
get
just.
it.
I mean, you look at some of these homes that they're selling. It's like, what? I just don't understand it. But
Here's something fun, Pat. You see this Sean here? I went down to a place called Wicked Rain in Gilbert, and Sean walks up to me and says, "Rick helps." So
oh yeah,
every once in a while, I get to meet some of you guys. It's really a lot of fun. So yeah, the rental properties plan on selling in February. I think I'll be in trouble. Um, eh, February. I mean,
I think
you're not gonna be below 2020 levels, Sean. So
no. I think people that are selling. I mean, you see that segmented market where you get the open doors, but then you got the people I see some of the histories that they bought the houses for. They bought it for 180, 190. Now the house is 450. They list it for 450. Yeah, they might be getting 400, but they're still making. They're not losing money. Their just rate of return has obviously been decreased somewhat.
well, it's
And
really hard when you're looking at that equity that you think you're going to get, and then all of a
yeah,
sudden it's gone.
yep.
I mean, I had a conversation the other day, and she said, "Yeah, I was planning on selling the first quarter, but I didn't." So, yeah, there's that.
Yeah.
So,
Well, I think we talked about a couple minutes ago. If rates, what are they looking to do? I mean, if you see rates subside here, we see a little push up here, but then you start to see rates subside first quarter, second quarter of next year. Are we going to see that? Because we see the reaction of people when rates do get into the fours, like, okay, the activity picks up dramatically. Correct, right?
yeah, because unlike the last time when prices made a huge reduction, we didn't have a whole pool of people waiting to buy. So, I'm hoping that doesn't happen. I hope that we just kind of muddle along around 3 to 4% for a good long time. And I
Yeah.
really don't want to see rates pop down and everybody rush to the gates again, because then we're creating another problem. In fact, it reminds me of that analogy I was talking to you about earlier today about China. China's got a huge debt problem, and they have thrown so much money out there that the analogy said their economy has to keep going so that debt doesn't catch up. And they said, think of it and they said they're almost about ready to collapse. Think of it as a train, and the final car in that train is on fire. And the only way to keep the fire from spreading to the rest of the cars is to keep that train going fast so the flames blow the other direction. So he said, so if their economy slows down, the rest of the rail car catches on fire. And that's what worries me about our debt. And I know we get spanked every once in a while because they think we're getting political, but politics and real estate are the same thing. Monetary policy affects real estate. And right now, I find it not puzzling, just sign of the times right now where the government is spending tons of money and the central bank is trying to pull it in. Two opposing forces.
Yep.
Reagan did a little bit of that in the 80s. He was spending a little more, mostly on defense, and trying to cut back everywhere else at the same time that the central bank was pulling back, but there was no separation between the two at this degree. Would you agree with that?
Yeah, there's a big separation. Matter of fact, you and I were started talking about this a couple of days ago, and I saw this article. The BlackRock CEO, Larry Fink, he was discussing inflation and investing in the energy sector. He said that, because I know we've gotten our legs cut from underneath us by, say, hey, we're getting political. But once again, I really think that you have to tie in, if you're investing in real estate, the political atmosphere does affect real estate, interest rates. Everything is tied together, whether we get political or not. But he had said, I'm just reading this article, BlackRock CEO, which is the largest investment firm basically in the world. They've got, I don't know how many trillions under management. He said that there's so much inflationary problems. He said, there's a very large fiscal stimulus from the U.S. government and governments in Europe amid the scorching hot inflation, suggesting such policies make it much harder for central banks to combat it. He goes, we have a disconnect between what policy is being proposed and what the responsibilities of the central banks are. Going on to argue it goes beyond fiscal stimulus. So, let's see here. I think that's Yeah, so
That's-
basically he's saying, the same thing kind of we mix a little politics in because you have to.
Well, you
little
have
bit.
fiscal stimulus. I don't
Yeah.
care who did it. We
Yeah,
have
I don't care if
fiscal
Democrats,
stimulus at the
Republicans.
tune
Yeah.
of $3 trillion. That's money going into the system. Just go to fred.com and look up M2. That's money supply. The chart is straight up. Money is flowing out, and the central bank saying, hey guys, we got a lot of inflation. We got to tamp this back. And he's actually starting to get chewed out by some people. I don't think you should use the word pain. And he's trying to raise a red flag and say, look, we got to start pulling this back or we're going to be in big, big trouble. And that's why he said that if we have 1 or 2 months of inflation that look good, he goes, I'm not going to stop then. It's got to be sustained. So this could be a couple of years while we're doing this. And I think for housing, it's going to help us with affordability. I don't see a crash, but I see an adjustment over a long period of time. Comparing to 2008, we had a credit crisis. You couldn't get a loan. Everybody walked away from their homes. They were vacant. Nobody knew who owned the loans, so it took a year and a half to foreclose on the property. We have none of that now. Now we have an affordability issue. That's different. We've had plenty of economic cycles in the United States where we've had an affordability issue that needed to adjust. This is just another one of those.
Yep, exactly.
So, and I don't ask me where rates are going to be next year and the percentage of increase in real estate. I have no idea.
Oh, come on, Rick, you do too. You're just not telling anybody.
No, I think I agree with the projection. It says about 2 or 3%. I can tell you that. I don't think it's going to be any easier to sell your house next year than it is this year.
No.
There's nothing in the pipeline that says it will be.
Yeah, I don't see anything cataclysmic, but we are going to, I think, muddle. I mean, there's too much excess supply in the real estate market in terms of even employees, mortgage people, real estate agents. You're going to see that contract, and like I said, the people that are buying right now, I said there's still that big pool of buyers out there. Yeah,
they're out in the wings waiting. Well, Pat, have a super weekend, and I will see you next week.
All right, everybody. All right, millions of viewers. Thank you very much.
Millions and millions. I'm looking at the clock there. I'm surprised we didn't blow up the internet.
We'll see you, everybody.